Well, guys, there isn't a central message from these minutes. Fed officials in general saw an economy operating in top gear. Solid growth, strong consumer spending, and increasing business investment. And that justified another gradual increase in their benchmark interest rate, particularly, the minutes say, because inflation might soon run above their 2% target, driven in part by falling unemployment that would push up wages. In fact, a number of participants expected wage inflation to pick up further, the minutes show. Quote, many business contacts indicated that they were experiencing rising input costs, and in some cases, firms appeared to be passing these cost interest through to consumer prices. Still, many noted that if the Fed stays on its current policy path, quote, the federal funds rate could be at or above their estimates of its neutral rate sometime next year. What could knock them off their path? Well, most participants, the minutes say, noted that uncertainty and risks associated with trade policy had intensified and were concerned that such uncertainties and risks eventually could have negative effects on business sentiment and investment spending. Many business contacts were already telling the Fed about scaling back or postponing capital investments. Contacts in the steel and aluminum industries expected higher prices because of tariffs, but had not planned any increases in investment. Policymakers also worried about deficits and what they saw as an unsustainable fiscal path here, as well as risks from, quote, political and economic developments in Europe and emerging markets. There was a long discussion of the flattening yield curve and all the reasons besides a rising federal funds rate that could be causing it. Some thought that it might now be a less reliable indicator of future economic activity, and a number said it would be important to watch. And finally, things might just be too good. Inflation hasn't accelerated rapidly, even though the unemployment rate has fallen well below their idea of what the neutral rate is. And, quote, some participants raised the concern that a prolonged period in which the economy operated beyond potential could give rise to heightened inflationary pressures or to fiscal imbalances that could lead eventually to a significant economic downturn. So, Scarlett and Taylor, basically what they're telling us is it is a sunny day for the economy, but there are some clouds on the horizon.
Mike, you talk about clouds on the horizon. We have the headline coming out saying most officials saw intensified risks around trade policy. Now, we had some tailwinds coming in that Powell has talked a lot about the fiscal stimulus. How much of that do you gather is going to be offset by some of the headwinds coming from trade policy?
Well, they seem to believe that there is a good chance that trade policy could knock some of the wind out of the sails, to use your analogy there. But at this point, they're seeing more good from the fiscal stimulus in the short run, noting the economy had grown strongly in the second quarter up to the point of the Fed meeting, and they expected that to continue at least through the year.
Mike, you also mentioned that some people saw the emerging markets, the overseas markets, as a downside risk to U.S. policy. We know that in the past, some people have commented that the Fed kind of has a third unofficial mandate, which is what happens overseas. Is it surprising to see this at this juncture, given that a lot of it seems to stem from trade concerns?
No, the trade concerns are outside the Fed's mandate, and that's not really their issue. But the strong dollar comes about in part because the Fed has been raising interest rates. And in the staff presentation, they did discuss the impact that has had on emerging markets. It is a problem, something to keep an eye on, but not a major concern at the moment.